This video is going to walk you through multifamily real estate syndications. What is a syndication, why use a syndication structure, and how it works. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about multifamily real estate syndications. First of all, let's cover the what. What is a multifamily syndication? Well, by definition, a syndication is a pooling of resources. And in a syndication for real estate, what we have is we have people with capital. So we have money over here that needs a home. And then we have another party over here that has a deal. This is going to be my multifamily real estate deal right here. This is a bad drawing. And we have another party with the deal. They know how to run it. So the syndication actually brings the investors with capital and the active party, the person who knows what they're doing, who has the real estate experience, the track record, the network, the team in place. A syndication allows the capital to get paired with the active party, and together a deal can happen. So it's really a pooling of resources, the resource of capital, and then we have the other three components of the real estate matrix. I've done a video and I'll put a link right up here talking all about the real estate matrix. We have four components. We have capital, we have the deal, we have financing, and we have management. And once all of those four components are satisfied, a real estate investment deal can happen. And a syndication makes this happen in a more efficient way, a better way for both parties, and we'll get into that when we start talking about how a syndication actually works. So now that we know what a syndication is, it's a pooling of resources, we have to cover the why would we use a syndication structure. And there are many different reasons that you would use a syndication structure. The answer is going to depend on whether you're a passive investor or an active investor. Let's start first with the passive investor. So let's start with passive. So the passive investor is going to be somebody with capital, with money they want to deploy in real estate for all these sorts of benefits, whether it's tax benefits, the stability in downturns, the appreciation gain, the strong cash flow, all of those benefits. An investor wants to realize those, and they have capital. But the passive investor doesn't have the track record in real estate. Maybe they don't have the real estate experience. Maybe they're busy working in their career full time, doing what they do best. They don't have time to start from scratch and build up a secondary business in real estate. They might not have the connections. They might not have the capital. On their own, let's say in this example, an investor has $100,000. On their own, that $100,000 doesn't really get you very far. If this investor wanted to purchase a property, they'd probably need a whole lot more than 100 grand. They'd have to put in time and effort to manage the property on their own. They might not have the experience. And at the end of the day, what do passive investors want? Well, they want a return of capital. They want strong cash flow. They want appreciation, and they want tax benefits. That's what an investor wants. That's why they're investing their capital. They don't want to put in the time, the effort, and basically make real estate their entire world. You invest your money so you can go out, live your life, and do things that you want to do. So a syndication allows that investor to place their capital with somebody who has all of that stuff. They have the deal, they have the track record, they have the team, they have the experience. So they will invest their money with the active party here, who will then deploy their capital and earn that return and make sure that cash flow comes through and all of that sort of stuff. So a passive investor will use a syndication because of the ease of access or the ease of deployment of that capital. Plus, we have to talk about risk. When I gave the example of this investor using the 100 grand and doing a deal on their own, well, guess what? They are an active party in that deal. They are shouldering all of that risk, and that risk is unlimited. So if something goes wrong with the deal, well, everybody can come after that, the owner of the property, and you can basically get sued and lose everything, not just the property. The passive investors in a syndication are called the limited partnership, and that is because the risk is limited to their initial investment. The active party, called the general partner, they are shouldering the risk in this case. So as a passive investor, you're deploying your capital into a larger deal, an apartment building that's going to give you all the benefits, plus you are limiting your risk exposure in that deal. This is what makes syndication such an attractive structure for passive investors. Now let's flip it over to the active party in the deal. So as an active party, let's say you have the deal, let's say you have the financing, let's say you have the management, but you are missing capital. Let's say you're taking down an apartment building, you need to raise $5 million. Well, one way to do it would be a joint venture and bring in partners, and then everybody's active in the deal. You might have too many cooks in the kitchen at that point. Maybe the investors don't want to be active and take and shoulder that risk involved. So then you can move to a syndication structure. And Wall Street has used syndication for quite a long time. And one thing Wall Street is really good at is efficiently raising and deploying capital. This is what syndication is built to do. So as an active investor, if you have the deal and you can run it, you have the team in place, you have the track record, but all you're missing is the capital needed to run the deal. Now you can syndicate. You can raise capital from a whole bunch of different investors. These investors are pooling their resources in the limited partnership of the syndication. The limited partnership deploys their capital into the deal to be managed by the active party. So if you have great deal flow, if you have the team, if you have the experience, if you know what you're doing, and you just want to scale your business and go after larger deals, well, syndication gives you that opportunity of efficiently raising large amounts of capital and putting it to work in the deals that you are doing. So now we know what a syndication is and why we would use the syndication structure. Let's go through how a syndication actually works. What is the process of syndicating a deal? All right, so let's start at square one. So the active party, the active partner in the deal, will find a deal. Right? They know they can make money on this deal. It's a good deal. They have the experience in the market. They know what they're doing. They know how to make a profit with this. What they need to do is they need to raise capital so they can close on the deal. They will have this deal under contract, but now they have to move it from contract to the closing table. So now they have to raise capital. And what they'll do is they will approach their investor database and say, hey, listen, I have this deal coming up. This is what it looks like. These are the returns. They will then send out a marketing package. So the marketing phase starts. And it's going to have all the details of the deal, the strategy they're employing, what they're looking to do in the deal, information about the market, everything you need to know about the deal is going to be in that marketing package. There's going to be webinars, phone calls, depending on what the active party, the sponsor of the deal, however they run things. So once the marketing phase has started, there's going to be something called soft commitments. And a soft commitment is really, hey, listen, I just sent you the marketing package. You just took a look at the deal. Do you think you might be interested in investing in this deal? And the passive investor will say, yeah, looks great. I'm interested in this, or no, it's not for me. At that case, the opportunity is dead. You can move on. But if the passive investor is possibly interested in investing, that's called a soft commitment. If you were to invest, how much do you think, just ballpark, how much would you want to invest? $100,000, $200,000, $300,000, $500,000. There you go. So now you have a soft commitment. And then once we have soft commitments, the active party, the sponsor, will do a PPM, private placement memorandum, or an OM, offering memorandum. This is going to have all the legalese the lawyers require, talk about the risk involved in the investment, everything that can go wrong, how everything is paid out. All those types of things are going to be in the PPM or OM. The terms are interchangeable in this case. Once the investors who made the soft commitment have reviewed the PPM or OM, they are going to sign something called the subscription agreement. The subscription agreement basically says, for X amount of dollars, I'm going to purchase X amount of shares. So basically, the passive investor is going to be buying shares in the entity. I'll walk you through that in a second. So the subscription agreement gets signed. They agree to wire X amount of funds or invest X amount of funds in the deal. And then we have funding. Once funding happens, the entity now is funded. It has all the money in the bank account, and then the deal can then close. Once the deal closes, the business plan gets put in place, and the active party, the sponsor of the deal, will start putting into place their value add plan, how they're going to generate a profit, a return for the investors. Now, I just want to cover quickly, without going too in depth, because I've got a whole bunch of different videos. I'll put a link right up here to one I did explaining about the syndication structure and the capital stack. But I just want to cover how a syndication is actually set up. So we've got the deal right here. Right? This is the property in question that is going to be acquired. Well, we really have two parts of the entity that are going to hold the deal. So we've got the entity here that actually owns the deal. So we'll call it 1, 2, 3. It could be an LLC or it could be an LP. In the US, I'll use the US as an example. And then for the parts that actually own the entity here, we have two parties. We have the GP and we have the LP. The GP stands for general partnership. This is going to be the active parties, the deal sponsor, the people actually working and making the decisions in the deal. These are the people steering the deal. The LP, the limited partnership, is made up of the passive investors. These are non-voting shares. So when I talked about the subscription agreement and the limited partnership, the passive investor buying shares, agreeing to buy X number of shares for this price, they are given, or they are allotted non-voting shares because they are completely passive, not making any decisions whatsoever. If they started to make decisions, they would put into jeopardy their limited nature of their investment, and then we get into all sorts of risk. And that's a whole different topic for another video. So generally speaking, the 50,000 foot view is we have the entity that owns the piece of real estate, we have the limited partnership, and we have the general partnership. Now, if you're interested in learning how the limited partnership makes money and how the general partnership makes money, I'll put links right up here to videos I did explaining all about profits and distributions and how that works with waterfalls and all that sort of stuff. So definitely check out that video. So now we know what a syndication is, why you would use a syndication structure, and how it actually works. So I just walked you through the whole process of a syndication deal. Now, and if you are interested in learning more about investing in multifamily real estate, join my free Facebook group right down below. It's a great mastermind full of amazing people who are always happy to help out. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.